Yeah, okay, we'll start the second part of the lesson. Again, risk and return calculation based on the expected data or the forecasted data as a continuation of the morning lesson. So we have identified the expected return for the particular scenario. Did we calculate expected return for this scenario? Right? No. So then you can start from the return calculation onwards. First, try to do the expected return. Calculate expected return. So you can read, have you read the question? The following, consider the following information related to the forecasted return of stock J and then the K under under four possible different economic conditions, right? So how many economic conditions? There are four economic conditions. Two, three, four. Four different economic conditions. So their probability is also given to us 10%, 20%, and then 50%. And last one, again, that is 20%. Right? Altogether, that should be 100%. So under the different economic conditions, you were given the returns of these economic return under the different economic conditions as like this. If it is, so what they are asking, okay, calculated expected return, variance, standard deviation, and then the coefficient of variation, right? Coefficient of variation, and then covariance and correlation coefficient, right? You have to calculate then 1, 2, 3, 4, and 5. 4 and 5 metrics. Start with the return calculation. First, try to calculate expected return for J, return for K. Restart.
Okay.
All right. So hope you all got the same answer for the expected return. We'll again calculate 0.1 multiplied by 8.5 and then 0.2 multiplied by 7.2 plus 0.5 multiplied by 6.5 and 0.2 multiplied by 4.2, right? Altogether, the answer is, altogether the answer is 4.68. Hope you all got the same answer. For the second one, that means the other stock, that is K. How can we identify? 0.1 multiplied by 8.5, 0.2 multiplied by 5.4 minus 5.4, 0.5 multiplied by 4.3, 0.2 multiplied by 7.5, right? All together. All together, the answer is 3.42 for the stock K. So this is the basics. So each and every question, risk and return question, you have to start off with the return calculation. That is very much important. After identifying the return, we know this means the volatility of the return. Now the second task of the calculating risk is identifying these volatilities. Rather than giving the years, previous years, now you were given which data? You were given the past data. So you were given the future data. Future data. Future data under the different economic conditions. We have 4 different economic conditions and then probabilities of these 4 different economic conditions are that much important, very much important. You can apply your own method in identifying these variances. First task is you have to take the difference. Take the difference. You were given the data, expected data 8.5, but average amount, the average expected is 4.2. So then identify the difference between 8 minus 8.5 and then 4.68. So you identify the difference. Right, we know as a basic step, you have to convert that difference into the scared balances. So therefore, the difference for the first scenario, the difference is minus 13.18. You have to take the scared value. Why? To avoid the minus and plus figures, take the scared balance. After taking the scared balance, now this is new to us. What is the new thing? Apply the probability. Right? Apply the probability. In the particular scenario, state 1 or the economic condition 1, the probability is 0.1. 0.1. The scared balance is 173. 173.3. This is the scared balance. After taking the scared balance, apply the probability. Apply means you have to multiply the identified scared balance with the probability. Identified scared balance, which is 173 multiplied by 0.1. That means our probability. Probability. Then we'll move to the identification of second asset. First row done. First row done means first economic condition and then J part done. So then we'll identify if it is a second asset or it's the asset K. How can we start the process? We know For the second one, for the stock K, under the economic condition number 1, the expected or the future return will be 8.5. But average, how much is average? That is 3.42. 3.42. Expectation needs to have the 8.5. This might be 8.5, but the expectation is 3.42. Take the difference. Difference is 5.08. 5.08. As we read in the morning, after taking the difference, apply what? Apply the scared balance. Apply the scared balance. This is minus. It should be minus. Is it minus or plus? It's plus, right? Plus. Then 5.08. Scan 5.08. Scared means exactly that is 25.80. 25.80. Please apply the probability, right? How can be 25.080 multiplied by the first economic condition probability is 0.1. 0.1. The answer is 2.58. Second economic condition. Second economic condition, highlight the probability that is 20%. 7.2 minus 4.68 and take the difference. Apply the scared balance. Apply the scared balance and then apply the probability. Given there, the future return will be 5 minus 5.4 and then your expectation is to have 3.4. 3.4, take the difference and then apply the scared balance and then apply the probability. Right. So this one for all the economic conditions. All the economic conditions. 4 economic conditions. But it's a variance thing. 20.49 and the other one 21.82. Variance. 20.49 and then 21.8. Is that right? Lalita, you tell me the answer. Yes. The answer for the first one, 20.49. Point 4. So what's the answer for the variance? 20.30. Variance for the gain? 21.84. Did you all get the same answer? 21 and then other one 20 point, around 20.49 or 3, right? So very good. Right. So now we know to identify to have the decision regarding the purchase or not to purchase, you have to calculate which metric coefficient of variation. Calculate coefficient of variation. It is very simple. V is divided by return. Oh, sorry, you are able to calculate the risk. How can we calculate the risk? We just studied the way. Right? How can we calculate the risk? Risk equals risk equal square root of the variance. Square root of the variance for J and then square root of variance of P. Tell me the figures. Standard deviation for J. How much is it? Square root of 20.42 and then standard deviation for K 21.82 square root of 21.8. The answer here is 4 point. The answer is 4.5. 4.5 good. The other one K 4.6. Now we have calculated risk and return. Then every risk and return question, once after you finalize risk and return, quickly draw this table. This is my advice. right? You summarize the information J and K, and then we have risk, and then very simply standard deviation, and then the R bar. Expected return, sorry, expected return. Expected return for J, that is, as I remember, how much is it? 4.68, and then K, that is 3.42. And then standard deviation for K, that is 4.5, and then K, that is how much? 4.6. 4.6. Once after you finalize the risk and return, quickly draw this one and then finish. So then you are very clear. K, how much is the standard deviation or risk and return, and J, how much is the risk and then the how much is the return. But as comparatively, you can't say like this. Okay, you had to invest on J without having the metric, right? So what is the metric there? Correlation coefficient. Correlation coefficient. How can we calculate the correlation coefficient? Standard deviation of J divided by expected return of J, the other one, standard deviation of K divided by expected return of K. We know standard deviation is 4.5 and then expected return is 4.68. The other one, 4.6 and then divided by 3.42. You can calculate and tell me the correlation coefficient. Rakshita, correlation coefficient. Correlation coefficient, yes, there 0.96, 0.96 and the other one 0.1.36. Now, as personal investor, which stock you can have to select? Is that J or is that K? J or K? K. K. Again, raise your hands also agree with K. I want to select K. Yeah, raise your hands. Hence, we can select K. Okay. K, K, letter K. Raise your hands if you agree with K. Lower your hand, and then those who agree with J, raise your hands. We want to select J. Raise your hands. Okay, lower your hand. Good. So what's the difference between J and K? Just think it. If you invest in J, for a one return, how much is your risk? 0.96. But if you invest in K for a one return, you have to bear 1.3 risk. Do you agree? Yes. So then out of these J and K, which one need to be selected? For a one return, only 9.6. That means you have to select stock J, because the covariance is, out of these two covariance is, lowest one covariance is the stock J, okay, that is J, right? Again, if you need further explanation, again I will explain. Here the particular case, covariance 0.96. 0.96 reflect. What it reflects? For a one return, you can have a one return, but your risk is 0.96. Whereas you are having the key, your risk is 1.36 for a one return unit. So then out of these two, you have to select J, okay, that is J. Is J. Then we'll go to the explanation of covariance. It has not been discussed. You can take down the heading covariance. Covariance. What do you mean by covariance? I will discuss both covariance and correlation and the coefficient. Correlation, sorry, the coefficient of variation, the coefficient is coefficient of CO. So now I will discuss correlation coefficient and then the other one covariance together. You can take down the heading covariance, and correlation coefficient. Covariance and then correlation coefficient. Correlation coefficient. I just search and write it quickly. Search and write it by your own first. What's the difference and all? What do you mean by covariance and then what do you mean by correlation coefficient? Yeah, this semester will be ending on 1st of April. First of April, is that 1st of April? The April. End of. Because this year, from the next week, I'm completing 12. Yeah, from the tomorrow's one, I will complete 10th one. Then we have 2 more weeks. Maximum 3 more weeks. Okay, 3 more weeks means definitely end of the April, end of the March. Yeah. That means you are trying to meet, you are trying to reach with, you are trying to reach with or else link with the other batch, right? And that might be 18C. Yeah, that might be. Because also they are starting their exams from the next week onwards. Are you clear what I'm saying to you? No? Oh yes. Are you clear what I'm saying to you? Recently, last week, I had been studying this. Yes, starting that it's but March, once I give me a services in March, so that April, the incomes, and the 6 subjects, we have 4 subjects today. You can your exams can be conducted within completed your this semester again. The exams are in very important. Exams negative. It's being right, so the line extensions of the line. Or don't have the exception of actually second system. It's right for the it's certain right and covariance and correlation points.
So, I see that.
Sorry, equivalences. And those are different equivalences, so the subjects. Yeah.
How can I fix it? Everything.
Right? The emotional relationship between who starts between four beings means the relational relationship. Relational relationship being positive or either negative. Right? But sort of a relationship in between start between return of some J and the return of T. Example, if the return of J increases, what happens to the return of T? And it might be increasing, K might be increasing. The other way around, if the K increasing, J might be decreasing. Sometimes J also increases, K also increases. Sometimes J also increases, K also increases. Right? Identifying this relationship is done by whom? And by the covariance. Right? Take it down. Covariance means covariance means covariance means the directional relationship, the directional relationship, the directional relationship between two stars which are the directional relationship between two stars here. Somewhere. When return of J increases, when return of J increases, when return of J increases, what happened here? into return of K. What happened with the K? You can write down the formula there to identify the covariance. Covariance. Again, covariance calculated. We know there are two stocks. You are going to identify the directional relationship. So then you have to consider two stocks. First difference of the both stocks, right? The given return and the expected return, and then you identify second stock, first difference, right? First difference of the second stock, multiply the first difference of the first stock, and then with the first difference of the second stock, and then specially adjust the probability there, right? Adjust probability one by one. We have 4 different economic conditions. Calculate these differences with the 4 different economic conditions and then take the total of it. And then total of it, which is called as the covariance, right? Covariance, how can we write it? Write in covariance. In between, we know there are two stocks, I and J. So therefore, covariance is between I and J. Then we'll write it down. Correlation coefficient. Take down the heading. Correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. What's the importance of the correlation coefficient? It can identify directional relationship plus the other one strength of the directional relationship. Write it down. Correlation coefficient identifies. Correlation coefficient identifies the directional relationship. The directional relationship and strength of that directional relationship. Strength of that directional relationship between two stocks return. Two stocks return. Okay. The way of calculating correlation coefficient. So we know correlation coefficient. Again, it identifies the directional and the strength of that two stocks. So therefore, you can name it I and J. What do we need to divide? Covariance. The calculated covariance can be divided by risk of first asset, right? Risk of first asset, and the other one, risk of the other asset. Multiply risk of the first asset and then with the risk of the second asset. Right? Risk. Standard deviation. So this is covariance. Covariance divided by standard deviation or the risk of I and then multiply standard deviation of J. So previous one, positive or negative. Previous means covariance only captured the positive or negative. But here the important is it is captured the strength of it. Right? Strength of it means definitely correlation coefficient in line with or the in between actually in between -1 to +1. -1 to +1. Definitely it should be higher than 1, -1, and then it should be lower than +1. Right? It is in line between +1 and then the +1, sorry, -1 here and then +1. This range. So if we know, if it is range in between +1 and -1, you can divide it in 3 categories. But these 3 categories are this is minus, this is 0, and this is +1. What is mean by +1? Tell me, +1 means positive. Positive means, we'll take the example, return of K, return of J. Positive. Perfectly positive means, if return of J increases by 100, right? Return of K increases by 100. Positive. Right? Sometime. Then -1 means -1. Return of J and then return of K decreases by 100. Here it is decreasing by 100. Then it is increasing by clear. So this is negative. Perfectly negative. Perfectly negative with the same percentage. 0 means we call this one as perfect. Perfect positive. Perfect positive. This is perfect negative. Perfectly negative. And then this is no relationship. No relationship. Here to here. -1 to 0 and then 0 to +1. How can we define? That is, this is, we know, moderate, negative, and then here it is moderate, positive. So this is how you can define the strength of that relationship. But either. Okay. Tell me, by looking at this formula, by looking at this one, right? If you know correlation coefficient, if you know the individual stocks, standard deviation, can we calculate the covariance? Yes, why not? We know this. We know this. We know this. We know this. How can we then calculate the covariance? Correlation coefficient multiplied by the standard deviation of I and then standard deviation of K equals what? Covariance. If you know these details, no need to go in detail as we lectured in the first one, before this one, to calculate the covariance, just apply this multiplications, right? So therefore, I rewrite. Go to the covariance. Do you have any space to write it down the covariance there? Check whether you have any space to write it down, any formula and covariance. No. Then go to the covariance and mark it there. First method. Go to your previous note and write it down. Covariance, first method. Mark it. The previous formula, first method. Number one. Then come to the new equation. Then write it down. Second method for covariance calculation. Second method for the covariance calculation. Second method for the covariance calculation equals covariance equals standard deviation of asset 1 multiplied by standard deviation of asset 2 multiplied by the correlation. This is very much important. Identification to both volumes. Standard deviation of first asset. They okay, and then multiply standard deviation of second asset. ST, standard deviation of second asset, multiply correlation coefficient. Now calculate correlation coefficient and then the covariance for the previous question. Correlation coefficient for the no. Okay. Correlation coefficient. Covariance. First calculate the covariance. How can we calculate the covariance? First difference, already we have calculated those. First difference multiplied by the second difference, sorry, first difference of first asset multiplied by the first difference of second asset, and then probability, take that value, go to the second class or the second state, and then first difference of the asset, first difference of the other asset multiplied by the stage number 2 probability. And we have already calculated those things. take the line by line differences with the probabilities and then take the probabilities. Not clear. That. Not clear. So we'll calculate first covariance. How many economic conditions do we have? We have 4 economic conditions, right? Probabilities of these 4 economic conditions, tell me first one, 0.1, second one, 0.2, 0.2. Now this is probability. Now tell me the first difference. What is the first difference? Expect return of the asset I minus expected return of I. That is how much? Is a minus or plus? Minus. Definitely in calculating covariance, sign is the most important. So therefore, you have to take the sign as it is, 13.18. Then first difference of the other asset. First difference of the other asset, return of I minus expected return of, return of J. Here we are taking IO. We have 2 stocks, neither. What are the 2 stocks name? Huh? J and J. Here J and here K, no? K and then expected return of K. What's the first difference? Rakshita. That is 5 point minus plus 5.008. Then you multiply this one probability with the 13.18, multiply with the 5.08 and take the answer. Likewise, you take all the 4 answers there. Then all the 4 answers, summation is what? Summation is the covariance. How many is the covariance? Minus. Okay, tell me the answers there. Answer here. Second one answer.
Double 0.
8. All together minus. Which one is important? Number or sign? Sign. So what is reflect? Minus 10.72 or 721 or 73. Which sort of relationship, Rakshita? Positive or negative? Negative relationship in between return of J and return of K. That means if the return of K increases, what happens to the return of J? Return J decreases. Write it there below it. Minus 10.71 or 72 minus 7.2 minus 10.72 reflect there is a negative relationship. There is a negative relationship between return of J and return of K. Return of J and then return of K. That is when return of J increases, return of K decreases. Now you can quickly calculate correlation coefficient. Take down the heading correlation coefficient. It is very simple. Covariance divided by the standard deviation of first asset multiplied by the estimate of second asset. Covariance is we know that is 10.73. Covariance is between J and K divided by standard deviation of J and SD of K. Covariance minus 10.73 divided by standard deviation of J. How much is it? 4.6 multiplied by 4. How much is it? 4.50. Definitely, we are receiving a minus sign. And then how much is the amount? 0.50. Which sort of a relationship? Definitely, in between 0 to minus 1 means negative. Which negative? Moderate negative, right? Moderately negative relationship in between the stock J and stock K returns. And it there, as per the correlation coefficient, there is a negatively moderated relationship. There is a negatively moderated relationship in between return of J and return of K. You can have a break. Can have 10 minutes break and you just have a 5 minutes break and come. We'll quickly finish that. That's possible. Yes, I just uploaded it. You can view it via the LMS, right? You can take down the heading portfolio. Portfolio risk and reward. So you have enough spaces. You can go there and start your writing. You come in early morning, right? And then, so when you are coming to the lecture, I know there might be several chairs available for you to sit. But you are sitting there, right? And then from the 8 to 6, you are struggling to write. Am I correct? You can come to this side. Then, ඇවිල්ලා බෑග් එකක් දාලා අපේ ඉඳලා 6 වෙනකම් ඉඳලා ගියා. ඒකත් තමයි ඒකත් ප්‍රශ්න. ලේසි දවන්නේ. මේක ලේසි. අනේලා බලන්න. Portfolio is capital. What is mean by a portfolio? Portfolio. Yeah, portfolio. Previously, we have selected based on the correlation coefficient and forbearance and all things, we have selected a one particular asset to invest. Right? Now, what the asset strategy what we are doing? So normally, you know, investors have different mindsets. Right? Whereas I'm trying to seek the asset, I'm trying to seek the risk. Someone don't like for the risk. Right? So therefore, based on the investment behavior is some subject, some subject. So you can analyze the investor's behavior before it has a psychological as well as behavioral finance. So the nutshell what you have to understand is investors are different to what you want. Right? So always investors are trying to make it kind of an investment. Yes, high return investments, but some investors are they don't like the instead of the high return, they don't like the high risk. Some are selecting high risk, high return investments, whereas some are selecting some sort of average return and then low risk investment, right? Anyway, so based on their different mindsets, rather than selecting a one particular asset or the share to invest, if you have funds, you can invest in more assets, right? You can more assets as a portfolio. Therefore, combining 2-3 assets into your investments, we call it as a what? Portfolio, rather than selecting the one asset. Now we have identified using historical as well as forecasted data, how can we calculate the risk versus return? That part done. Now we are trying to identify, we are selecting 2 stocks to invest. How can we identify risk versus return of that portfolio? So therefore, take it down there, draw the mind map. Right? If you want, you can go to the first page as well. Right? Risk and return first page and write it down. Portfolio. Portfolio. Portfolio means combining more assets. More assets into a one investment. That means previously we have selected, this is an example. Previously we had J and K. We just select J or K based on the numerical figures that we receive. Right? We have selected the J as I remember. But now what we are doing? What we are doing right now, rather than selecting J and K, or rather than putting my all the money, all my cash into J, you select both to invest J 75% and K 25%. I have 100,000. So then tell me how much I have put to J and how much I have put to K. Right? How can we identify? 100,000, 75%. That means 75,000. I have purchased the shares for 75,000 in J and then 25,000 per shares in K. Right? So you know, for your syllabus, we are just discussing about the 2 stocks portfolios, right? So then, so your investment previously your money entirely invested on J. Now your investment segregated into 2. What these 2 are? J and K. So now the weight is coming, right? This is portfolio, entire portfolio. Weight in this portfolio is 100, right? Previously also 100 investment. Now, partly, proportionately, we have made the investment in J and K, whereas new concepts involved here, we call it as what? So this is called as the investment behavior. Several set of investors minimize the risk as well as the expected return. Investor behavior. What is portfolio and then weights, right? So then we have a new term there, that is what? This is weight, we call it as a W. Very important terminology in identifying the portfolio. We know always all the metrics, the stock can be mentioned below the metric, the wordings there, right? So this is weight, we know this is weight for which one? It is J. If it is covariance, you covariance of J, right? If it is standard deviation, SD of J. If it is expected return of J. Always J means the stock should be below the numerical metric mentioned there. Right. So then weight J and then here weight on What is the weight on J? How much is it? 75%, and then weight on K, 25%. Both together, that should be 100%. This is depend on the investor's perspective. Much of selecting from A, or else how much of selecting B, how much of from the A, how much from the J, and then how much of the K. So given here the some sort of different portfolios, right? So let's assume here we have how many students? Talitha. And then Ishara. Sumudu. And then last one, Lakshit. Right? So both you have A and B stocks. Right? You all have 100,000. Right now you all have 100,000. Monday you all are going to make the investment. Select A or B. Right? So Talitha form the portfolio number 1, that is as per section. How much is goes to A and how much is going to B? Yeah, how much is on A? Tell me, weight on A is how much? 10%, and then weight on B is 90%. Right? The girl Ishara. Right? Ishara, according to her perspection, she has allocated 30% on A and then 70% on B. Sumudu allocated 50% on A, 50% on B. Last one, Lakshita, 60% of A and then 60% of B. This is up to the person to person, that is different, right? But anyway, you have to understand weight on that particular share, right? Weight on the particular share, we noted it as a doubling. Now take down the heading, expected return of the portfolio. You can take down the headings for 8 and 9. If you want, write it down the other, but you write it down, right? If you want, you can keep the space, write it down the heading, and then write it down the expected return of the portfolio. Tell me, so if I selected two, I selected two stocks to my portfolio. Now, how can I receive the return? Selected rather than selecting one. I have selected two shares. Right? How can I receive the return? And answer is okay. Contents. We will take the scenario like this. Okay, please option number 1. We'll take A. Invest in B. Am I sharing the screen? Yeah, no? This is invest in A. Three different cases. How much I have? I have 100. I have 100. 100,000. And this is rupees. The share price is 10. So then I can purchase here 10 rupee share. 10 rupee share. How much of shares I can buy from the invest in A? How much can I buy? I have 100,000. 10,000 shares. First, I have select the investment in A. Right? How many shares? 10,000 shares. Right? At the end, my return is now 10%. Right? Or 10 rupees. You take it as 10 rupees. No? Calculate the total return. Then again, how much is it? How much is it? That is now 100,000. Right? Then, if I select in investment in B, how many shares? I will take 20 rupees. 20 rupees. How many shares I can buy now? 5,000. 5,000. Again, rupees 10. Right? We'll take return 10. How much of investment? How much of return I can earn? How much of return I can earn again? 50,000. I have selected. If I select only A, my return would be 100,000. And if I select investment in B, that is 50,000. You can identify the isolate investments there. Now, I invest in both. Right? What are the prices now? For the A, how much is the share price? 10. For the B, that is 20. And I have invested it on a weight on A, that is 50. Weight on B, that is 50. Okay. Now tell me the shares, number of shares then. Here how much? How much? 10,000? Yes or no? No. Why? Tell me the amounts. I have 100,000. 50,000 allocated for the A and then remaining 50,000 allocated for the B. Segregated my funds among these two shares. Is that clear to you all? ලක්ෂයක් තිබුණා 150ගේ එහෙනම් මං හිතනවා 50000 shares ගන්නවා කාගෙන්ද? A 50000 shares ගන්නවා B. Then tell me number of shares. Number of shares. How many shares? How much here? How much here? 50,000 divided by 10. Here 50,000 divided by 20. This is 2,500. This is 5,000. Now calculate the return. How much is return? Return is 10 rupees and then return also same 10 rupees. How much is return now? Return 50,000. 50,000. Am I correct or wrong? Yeah? 10 rupee shares 50,000. Here how much is it? 5,000. Sorry, 2005. Ne? Two, 5. 20, 25,000. What happened to the entire returns? If I invest in entirely A, my return would be 50,000. 50,000. Sorry, 100,000. Since I have made the weight on there, what happened? Now from the portfolio, what I receive? Tell me. Okay, we'll build a formula for this one. Right? So expected return from the individual stock. Am I correct or wrong? This is expected return from the individual stock. Now it is not 100, it is how much? 50,000. What happened to it? My weight has impacted to identify the portfolio return on A. How can we multiply it by, this is what? Weight on A. Is that all? No, right? I have another assets also, right? So what would be the return on B? Expected return on, this is A. Expected return on B. Expected return on B. This is A. Right? What happened to it? Previously it was 500 or 50,000. Now it is 25,000. Why this is? This is because of this weight. Right now, multiplied by weight on B. So then individually 50,000 and separately 25,000 separately. No. What you have to do is, this is a portfolio. Now I have invested my investment in two different assets. So this is a one. So then you have to add these returns. So this is how can we identify the portfolio return. Are you clear? Okay. Please note it down. Share price, weight, rupee value, here rupee value based on the weight, and this is number of shares. This is return. Return for a share. Return for a share. Per share return. You can switch off this. Okay. Standardized formula to calculate then portfolio return. How can we? We know this one. Weight on I and then weight on, sorry, expected return on I. What do you mean by summation here? Why? Why? You might have other different assets also. Therefore, if there are like that, take the summation up, right? Now take down the heading, expected risk of a portfolio. Write it there, expected risk of portfolio. It is risk calculated based on the weighted return. How can we calculate the, if the return is calculated based on the weighted return, then how about the risk of the portfolio? And it will be based on the weighted risk. And we, right, not only the weighted risk, there is another component for this calculation. So let's write it down. As per double summation method, as per the double summation method, as per the double summation method, To calculate the expected risk of a portfolio, let us use it to calculate the expected risk of a portfolio. Identifies three factors that are impacting for to identify risk of a portfolio, to identify risk of a portfolio as mentioned below. First one. Weighted variance of the stock market. Weighted variance of weighted variance of first stock. Weighted variance of second component. Weighted variance of second stock. Weighted variance of second stock. Third one, covariance among third one, covariance among two stocks figure. Two stocks. So this is the formula. You can write down the second formula there. So this is for the variance as per the double summation method. So this is to variance. This is double summation approach to calculate the expected risk of the portfolio. First formula is to identify the variance. Right? And then second one, standard deviation of portfolio. So this is the maximum involved in the right hand corner. You write it down first, so then I will explain the three components there. We mark the three bases. Thank you very much. Tell me, what is the first one? Read it. What is the first one? Read the first component. What is it? Look at your note and tell me. Weighted variance of first stock. What is the first stock? I. Weighted standard or is weighted variance of the stock number 1. Right? Since it is a double summation approach, you have to scatter the weight. Right? Weight should be scattered. Multiplied by standard deviation also scatter. Standard deviation scatter means the other way around. What is it? It is variance. Right? So that is why I have given there weighted variance of which one? First stock. Right? Very simple. This is very simple. Even the formula has a bigger components. Second one. Weighted, what is the other one? Weighted variance of which asset? Stock number 2. Stock number 2. Third one. Read it. What is the third one? Weighted covariance or the covariance. Here it is covariance, right? Weighted covariance. How many stocks in this portfolio? How many stocks? We have 2 stocks. So therefore, this is co-weighted covariance among how many stocks? 2 stocks. Right? So these are the 3 components. Third one, second component, first component. Weighted risk of stock number 1, weighted risk of stock number 2, weighted covariance among 2 stocks. Weighted covariance among 2 stocks. Right? So this is variance. No? So then how can we convert it to the standard deviation? Applying the square root. Like the square root. Without square root, what is this? So without square root, what is this? This is variance. With the square root, this is standard deviation. Are you clear on this? Shall we quickly do the calculation for the previous questions that we did? Just write it down. Example number, write it down. Continuation of example number 3. Write it down. Continuation of example number 3. Quickly summarize the information first. Previous question we have identified. We calculated J, K, standard deviation, and then expected. Okay, quickly tell me. Standard deviation 4.5. This is 4. How much is it? 6. Here 4.68 and then 3.42. Right? Just imagine, rather than selecting a one stock, the particular investor, right? Particular investor invested in these 2 stocks equally, other than selecting one, right? So then tell me quickly, what is the weight now? Weight on J, how much is it? 50%. Weight on K, that is 50%. Clear? Rather than selecting JOK, he has decided to invest in both. It's like this. 50 J, 50 K. Now the question is return and then the other one. You can do it. Try to do it. Then we can finish. We'll calculate quickly the return. If I select J, I will receive 4.68. And then if I select K, that gives me 3.42. But now this time I am going to invest this proportionately. That means 0.5. What would be the return? We call this one actually as the expected return. Expected return of portfolio. This one also expected return or expected risk of that is 4.0, 4.05. Then just apply the double summation approach. Double summation. 3 stages. Scared, weight on J multiplied by variance of J. Scared variance of K multiplied by variance of K. Third one, 2 stocks we have in this portfolio, and accordingly we have 2 weights, weight on J and weight on K. Other than that one, you have to consider the covariance, COV. COV. It should be COV. Yeah? COV. In between K and J. That also calculated. We'll apply now. 0.5 scared multiplied by, no need to take the standard deviation and scared it. Why? We have a variance, right? How much is the variance? 20, 20.49. So then 0.5 scared multiplied by 21.82 or something, and then add 2 stocks. Weight is 0.5, 0.5 multiplied by covariance is minus 10.73. Take the scared balance. We just apply what we have wrote.
Oh, 10 points. Ini perlu. Saya sendiri. Lagi kan? Lagi kan? Ini pakai di sana. Dekat dunia dekat. Jadi, asal. Dekat dekat. Only through standardization we can achieve because
So then we'll wind up from today. So we'll start from the remaining from tomorrow.
kami hari ini. Ini kita